Good morning, traders and investors. Welcome to pre-market prep with stock odds to end the week, this January 27th. Turn for the worse here in the market. We did hit 93.75. Now we're right on the session. So now we're actually down by 2.5 handles. Pre-market low, 57.25. Not looking for any major downside till we get through that. The buck is up 8 cents, 101.72. You got your bonds down just a little bit over a half a point. Boy, crude, when you get tired about me talking about the 82 handle and the resistance there, you just let me know. We're down 14 cents at 18 or 80.68. Gold in the red by $10. We got a whooping going on here in the market at 1937.20. High ho silver, that's down 55 cents at 23.47. And Bitcoin is down 110 at 23,225. Rob, you better get some bids out there to stop this market from going down here. Wait, we don't have bids. We don't have Rob. Rob? There he is. Hey,
Sorry,
Rob. You
had
need
to take a call. Had to take a call from Goldman there. Okay.
Oh yeah, or it wasn't. Well, you know, when my phone
if
rings,
the gold man calls, you got.
Let's talk about crutch trading.
Can't ignore the gold man. Okay. Oh, anyway, let me share my screen. We'll get right into this. We only got like 12 minutes or something to do this here. Let's see if we can share the screen. Let me know when you see.
I'm looking. It says Rob has started share screen. I got it. Rob.
Got it. Okay. All right. So what we know, I mean, many of your listeners here, they already know the stats on how often gaps are filled, right? So if we go back throughout the market's history, we know that a lot of gaps get filled, both on the indices as well as on the individual stocks, right? So case in point, yesterday we opened up and we filled the gap, right? Today we opened down slightly, we filled the gap. And yesterday, or the day before that, it opened way down. It took all day to fill the gap, right? So open down, just about filled the gap initially and then filled the gap later. So, it's not 100%. It's, it's in the 60% area for the SPY on the bullish, if it gaps up and then retraces, and then a little lesser amount than that on the downside. But it's, anyway, you guys can look up the stats for yourself. I don't want to talk about that as much today as crutch trading. So, but there is a similarity. So let's go to Google here.
Okay.
So when we talk about Google, gaps get filled on the stocks as well, right? Just like with the market. So there's lots of opportunities to trade and for reversals and things like that. So I just want to run through. When we look at crutch trading, you want to find two instruments that are highly correlated, and you put them in a ratio spread chart first to make sure that you understand what amount of position size you should have on one versus the other. So Google divided by Google L is 1, right? 1.01. So that means that we can pretty much run at a differential spread price, which is 1 minus the other. Okay, so that's what it looks like here in terms of the differential spread price. So we do have in the Learning Academy a course on crutch trading. I actually used Google as an example for pair trading and crutch trading as well. And at that time, it was, of course, $2,000 a share, which was pre-split. Made it a lot more difficult for people, but there was a lot of movement. And of course, the bid-ask spreads on those things are pretty wide, so you got to be accurate. So that's all changed. It's like the Shopifys and the Amazons and the Apples, when they split, sometimes they get easier to trade, but also more competitive. And, it's important that you adjust for what their new price is at. But with Google, thanks to Eric there that sent me a message to say how much the education has helped him with this particular spread. So I thought let's talk about it. And one of the the things that you look for obviously is if you've had a gap on one of or on the stock should move in line with each other most of the time. So if you have a gap on one and there's a potential to fill the gap, there's your first trade opportunity from a crutch perspective, right? So let's just say that Google opens down and it starts coming off the opening event area there, what we call the opening range, starts moving up to fill the gap. There's no reason that you can't go with it and have your other side of the pair as your hedge. That's what a crutch trade is. So there's a couple things that are really important to remember about how you gain a win-win or wash environment. Okay, the goal is not to set yourself up for losses. The goal is to have a win one way or a win another way, or maybe wash in a sense that you just break even, okay, minus costs. So how is that possible? Well, if you look at where the spread is right now, you can see that the movement on Google minus Google L has been, getting close to its normal ATR. Like we can just eyeball that and we can see how much it tends to move for the day. So let's say $1.15 to $1.65. So even $1.10, maybe at the most there to $1.65. So say 55 cents of movement per day is kind of your maximum that you'll see on average. Okay. So if we're already moved here from $1.70 down to $1.30, we got 40 cents. That discount on the spread relative to where it was trading, you'd be expecting some reversion of the mean back to 150. So yeah, you could put the spread on by buying Google and shorting Google L and have that potential to make 5 cents, 10 cents, 15 cents. Obviously, in a commission environment, you got to consider that. And also you have to consider any slippage as you go in and out. It's a little bit difficult with these very efficient spreads to sort of place one side and then get filled and then get the other side on at a great price, because there's a lot of automation and they move extremely quick, right? So in the sense of like you getting caught by getting one side on and then having to chase the other side, yeah, that can happen a lot. So automation is got the edge there, and I've had lots of traders take all of these efficient types of spread relationships in the common and the preferred and all the different classes, apply automation to it, and actually make a living, and a good living over the years. For point and click traders, you can't compete with that level of automation. So you have to look at it a different way. If you align the opportunity on the stock with the spread price, that spread price is actually one of the most important things. So right now, Google is at a discount to Google L in the context of where we've been for the day. And it could even be in the context of multiple days. So let's just say that is the case, that it's discounted for the day as well as on a multiple day basis. So where's your edge? The edge is in buying the first symbol and shorting the second symbol, looking for that mean reversion. So like I said, there might be a dime, there might be 15 cents, 20 cents, whatever in that opportunity alone. So your starting point has to be a great spread price. Because if you took a crutch trade, so let's say right here, the market conditions supported buying Google, well, you would want a great spread price, because if you were wrong and you had to lock the other side on, you don't want a horrible spread price. This isn't about speculation. This isn't about your feelings or even what your technicals are telling you might happen. It's really about the quality of that spread number, because if you have to lock it on, you want to add a bit of time and still come out okay. That's where the win comes in, or maybe you got a lot of inventory and you have to kind of wash it out and you say, okay, well, I'll wait for a better opportunity, right? So win or wash is what I say. So at this point here, okay, what is the market doing? So we can look at, the Qs, or we can look at the SPY. What is the market doing? Let's look at the SPY here. Okay, so the SPY's come down. The SPY opened down, filled the gap, went up, came back down. So let's just say that the SPY has moved to the point where there's a potential reverse opportunity to head back up. Okay. So if Google tends to be somewhat correlated to the market, which it is, and you've got an opportunity for the market to rally, then it makes sense to buy the Google. So what the spread price is telling you is that there's two things that you can do with a good discount on the spread. You can either buy the first symbol, or you could short the second symbol as your crutch trade. Buy the first symbol or short the second symbol. Okay. You don't buy the second symbol. Why not? Because if you bought the second symbol and you were wrong and you had to short the Google to hedge yourself, you would have it on at a terrible spread price. You would be short the spread down here. So crutch trading works on highly correlated, efficient spreads that, even if they're tight, maybe they only move 10 cents a day. You're not going to, a point and click trader is probably not going to make a living off of one spread moving 10 cents a day. But from a crutch trading perspective, you want the confidence that when you lock on the other side, you're hedged. So then if you're hedged, what do you want? You want your starting point to be a great spread price, because at a bit of time, you'll probably come out of that okay, either a slight win or a wash. So with crutch trading, you have the ability to win on your crutch, win on your initial trade, having the crutch standing by. That's what that means. And if you're wrong, you lock on the crutch. So now you're hedged, and add a bit of time, or even a 2-layer approach where that's your first layer and you're looking for a better layer. You don't want to build up too much inventory though, because they're so efficient and there's carry costs and all that. But the key to this that I can't emphasize enough, it's not about speculation. It's not about gambling. It's about lining up some ducks from the market opportunity, what the market's telling you, what this follows, whether it's the Qs or the SPY or the diamonds. Who cares? What is its reference security? What does it follow the most? What is it correlated to the most? Okay. And looking at that, looking at your leading indicators, looking at your market opportunity, you go in to get either one side, which is the Google, or the other side, which is Google L. But which one do? You do it based on the spread price. If you miss that, then you're not going to be an effective crutch trader. You have to align yourself with the spread number. So at this point, yes, the spread could move lower. I don't know what it will do. It could move lower. It can move higher. We don't know. But from a mean reverting potential and behavioral aspect, we want a great spread price because that gives us the ability to buy a bit of time. It gives us the staying power. It gives us the opportunity to trade one layer, maybe have another layer standing by, put it on, trade the second layer, keeping the first layer. There's all kinds of things that can happen, but your starting point is the crutch trade. And the key to it is a good spread price. And the spread price tells you which symbol has the edge. Not your technical indicators won't tell you which symbol has the edge. I could throw, onto Google itself or Google L, I could throw all kinds of things on there. There's Google L. I mean, what are your technical indicators going to tell you which stock is advantaged over the other? It's not going to happen in these types of relationships, right? You can use your technicals to look at the potential for reversals and, support and resistance and all your different levels. You can use all of that. That's fantastic. And that's why I was saying in a situation like this, where it opened up and it moves down and fills the gap, just like the behavior of the S&P 500 does often, fills the gap, that gap fill point there, looking for a potential of a reversal. So at that point, if this is Google L that's filled the gap here, and you want to buy it, does the spread price qualify you to buy it? Does the spread price give you that edge? And that's the key right there. Okay. So on these one-to-one relationships, you can just do one minus the other. If, of course, the prices were hugely different from each other, you would have to do a factor adjusted spread, which is use a multiplier in there to get you close to a zero spread price. But the same principles apply. What is the quality of the spread number? That helps you decide which stock to do first. Okay.
Okay. All right. We're going to wrap things up here. A little bit of a volatility on this Friday. Down 7.25 handles at 40.68. That let's just concentrate on the closing price today and or from yesterday. I wish I knew the closing price for today. 75.5. I think that's a big number. I see some stocks still trading above the close, but I'd say unless we could get this thing back above 40.75 and a half, that was your high close of the move. Path of resistance lower. Great job, Rob. And we'll be talking to you on Monday.